A new round of US tariff letters includes a 20% rate on the Philippines. There's uncertainty in the copper market as traders wait for detail on Trump's 50% tariff talk. The Reserve Bank of New Zealand dovishly holds rates, while Malaysia pre-emptively cuts. That's coming up in our 5 Things in 5 Minutes on Thursday, July the 10th. And then, in our deep dive interview, ANZ Senior Commodities Strategist Daniel Hynes analyses how the LNG market is playing a role in the tariff scramble.
Demand for natural gas is strong, and that is a potentially quick and easy fix to trading surpluses that they hold with the US. So I suspect one of the levers in the negotiations will be that they'll agree to purchase more US LNG.
President Donald Trump has released a new round of tariff letters, including a 20% rate for the Philippines, which is up from 17% on Liberation Day. More letters are expected in coming days. Meanwhile, the copper market continues to reel from comments by Trump that he's considering a 50% tariff on imported copper. ANZ Senior Commodities Strategist Daniel Hynes says there's still a lot of uncertainty about the detail.
We're still not sure about what it's applied to, whether it's refined metal or if it's concentrate or copper ore coming into the market. And does that then flow through into products, semi-processed products like copper wires and pipes and things? It did surprise the market, at least the level that Donald Trump quoted, that 50% tariff. What it's going to do initially, though, is clearly incentivize US consumers to hoard as much metal as possible.
As of 4 a.m. Sydney Melbourne time, the S&P 500 was up 0.4%. The 10-year US Treasury yield down 6.5 basis points to 4.35%. Gold was flat at $3,317 an ounce, while West Texas Intermediate futures up 0.4% at $68.57 a barrel. COMEX copper was down 2% in New York trading overnight, having risen 13% the previous day after Trump talked about a 50% tariff. The US dollar index was up 0.1%, the Aussie dollar up 0.2% at 65.36 US cents, and the Kiwi was down slightly at 59.95 US cents. Number 2, the Reserve Bank of New Zealand held its official cash rate at 3.25% as expected yesterday. ANZ New Zealand Chief Economist Sharon Zollner says it was a dovish hold to give the rate-setting committee more time to analyse inflation and expectations data.
At the end of the summary record of meeting, there was more than a hat tip to the fact that they are likely to cut in August. They said, subject to medium-term inflation pressures continuing to ease in line with the committee's central projections, the committee expects to lower the OCR further, broadly consistent with the projection outlined in May. So in May, their forecast showed a cut either in July or in August. So that was a very clear signal to the market that all else equal, they do expect they'll be cutting in August. And so that was an important message to send because it stopped the market just assuming that the easing cycle is over.
Number 3. Sharon says ANZ Research continues to expect 3 more rate cuts as underlying economic momentum softens in New Zealand.
The Reserve Bank's May statement implied another 15 points of cuts on top of a cut in either July or August, so 40 points all up. For our part, we're forecasting consumption and the housing market to be softer than the Reserve Bank is expecting over the second half of this year. So we've got a cut in August, another in November, and then a third one still penciled in for February, though that one is very much a placeholder for the very uncertain impacts of the global uncertainty that we're seeing at the moment.
Number 4. Another rate decision. Malaysia's central bank reduced its policy rate by 25 basis points to 2.75%, the first cut in 5 years. ANZ economist Arindam Chakraborty says it was a preemptive move to support growth amid a volatile global trade environment.
Uncertainty has remained elevated for longer than previously anticipated, and this is weighing on sentiment and the growth outlook. Overall, the central bank sees growth staying in line with its expected path in 2025, despite accounting for some moderation in the second half of the year. As a result, we do not anticipate another rate cut by BNM this year. However, we will closely monitor if slowing exports going forward start to materially impact income growth and household consumption.
Number 5. China's producer prices fell 3.6% annually in June, the biggest drop in 2 years. However, consumer prices rose 0.1%. That was better than expectations after 4 months of falls. ANZ Senior China Strategist Zhao Pengxing says an expected strong GDP print next week may push rate cuts further back in the year.
Recently, I think China has changed the policy from the short-term stimulus to long-term structural reform. That means the interest rate cut is still in the toolbox, but will not be used very in a hurry. We expect interest rate cut in Q4. Q3, I think it will be generally okay, even with very low CPI number. Broadly speaking, I think the inflation pressure will ease in the second half of the year.
Xiao Pengxing there. Now, in our deep dive interview, ANZ Senior Commodities Strategist Daniel Hynes looks at the key role LNG is playing in tariff and trade negotiations between the United States and its trading partners.
A lot of the trading partners the US are trying to strike deals with, they are energy-hungry consumers, Europe and Asia in particular. When you look at Asia, outside of a couple of producers like Malaysia, and throw in Australia there, but there isn't that much supply coming from the region, but they are hugely energy short, particularly countries like China and India. So, the demand for natural gas is strong, and that is a really quick and easy sort of, or potentially quick and easy fix to the surpluses trading surpluses that they hold with the US. So I suspect one of the levers in the negotiations will be that they'll agree to purchase more US LNG. And look, there's plenty of projects on the pipeline at the moment, but I suspect those US LNG exporters would actually struggle to meet all of the potential demand should all of those trade deals come through.
Yeah, because there has been a significant increase in production in the United States, but they've still got more to go. What might slow things down or make it more expensive to do that?
Well, certainly, most of their gas obviously coming from the domestic market. We're seeing strong demand in the US as well. So that could certainly tighten the amount of gas available for liquefaction and export. But also the cost of shipping this LNG, particularly to Asia, the longer distances required, does mean that $3 or $4 it may be selling for in the US becomes closer to $12 when it eventually lands in countries like China. And sometimes that's not always competitive. At the moment, the spot LNG price is around that $12 mark at the moment. So it's not always financially viable, I suppose, for US LNG exporters to sell into Asia.
And thinking about the tariffs on European and other steel and aluminium exports into the United States, how is that feeding through into the cost of bringing this new LNG on?
Yeah, well, it doesn't get any easier. I mean, the cost of these projects are huge, and with the potential for steel and aluminium costs to rise quite significantly, and look, they've got 25 to 50% tariffs on them at the moment, that's going to really add to the complexity of a lot of those projects, and they will have to run the ruler over them once again with the scenario of these tariffs remaining in place for the foreseeable future. So not only is it the cost of delivering it into Asia, it's that return on capital that they would obviously be looking at as well, including the cost of those export terminals. So that just adds another layer, another difficulty, I suppose, for getting this LNG to the market.
And China has been one of those that is assumed to potentially double its imports of US LNG. What are the risks there, given trade relations between China and the United States are not as smooth as they haven't been in the past?
Yes, and we've got a pretty recent example. I mean, in Trump's first presidency, we saw China agree to additional US LNG purchases. It did quite briefly after that deal was struck, but that didn't last too long, and we saw that peter out. In fact, part of the most recent trade tensions have seen China essentially ban the imports of US LNG by applying a levy on those purchases. So it's clearly going to be an issue within trade negotiations. Whether it resolves itself in China's perspective will certainly be a key determinant around whether we see those trade flows re-emerge.
And looking more broadly at all these competing factors, what do you think it means for LNG gas prices on global spot markets, firstly?
I think amidst these potential trade deals that we see coming through, I really feel that, not that we've seen it yet, but global gas prices will start to converge, potentially see higher in the US where they are lower at the moment, and come up to, I suppose, those global benchmarks like the European gas and the North Asian LNG, which, could ultimately mean higher energy costs for US consumers in particular. Otherwise, I do feel like it's going to further legitimise the global LNG market. We would most likely see a much more liquid market, which would really reflect more than it has in the past the supply-demand dynamics within the global gas market as well.
Daniel Hynes there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, July the 10th. Catch you tomorrow with analysis of how the US jobs market is performing as Federal Open Markets Committee members weigh up their rates decision this month. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.